stock market is entering, if not already in a bear market. A recession may just be right around the corner. What can you do with your money? Is there a way to invest in a bear market? Welcome to Finan Simple, where money is made easy, and allow us to teach you how to become a millionaire during these times. During these kinds of downward markets, good assets, good investments now become available. People get scared, they sell their assets. When they sell, it pushes the prices across the board to drop. To begin, invest your money in general America. Over the last 100 or more years, the American economy has been able to survive through negativities. They say inflation will destroy the economy, even destroy the dollar. But booms and busts are always a part of the economic cycle. You want to know how to maximize the booms and the busts. Here, you will be able to buy assets at a discount. Now, how will you invest in general America? One way would be investing in an ETF, also known as exchange traded fund. It exposes you to investments such as the S&P 500, which are a group of the largest 500 companies on the American Stock Exchange. Let's say you collect all these companies and put them into one symbol. If you invest in that symbol, you basically are investing in all of them. Now, there are several big ETFs that let you do this, but the VOO and SPY are examples you can use to begin your research. So, America is going through economic crisis. A recession comes into play. A bear market occurs. Guess what? Those largest companies will definitely be affected. Prices fall and their stocks will be available at a discount. If you decide to invest in ETFs like the SPY, you are capable of owning a piece of the 500 largest companies on the exchange at a fraction of the price. Once stocks gradually increase again, you have been able to buy them at a sale. Now, you will be able to grow your shares in those companies. But how is investing in one company different from an ETF? Individual companies tend to be more dangerous. There is more risk, more research for you as well. You invested your money into Amazon. If you're not doing the work, researching, investing all your money into Amazon, then they go bankrupt. All your money is wiped out just like Amazon. For an ETF, there is less risk. You are investing in a group of companies. If one goes bankrupt, then the company will be removed and you will invest in another. An ETF diversifies your portfolio by exposing you to many companies or sectors depending on the nature of the ETF you chose. It is definitely less risky, but if you really want to invest in individual companies, go ahead. Bigger returns are a possibility, but you have to be consistent in researching. If you are too lazy to put in the work but still want to invest in individual companies, there is still a way. You can hire a stock advisor or join advisory groups or services. They will basically do the research for you and give you expert advice on stock picks. Someone has to do that research and they can do it for you. Number 2. Invest in tech. The changing economy will greatly impact the tech sector. May it be the next 6 months, even the next 12. Interest rates are continuously going up, which hurts the speculative companies, tech companies, and growth companies. The tech sector will definitely go on sale. Some companies will be wiped out of the market, but this is where there will be opportunity. You have to be able to find the good assets among the bad, while toxic assets cause investors to sell positions and cause overall prices to drop. This environment will pull the price of good assets down. The tech industry is not going anywhere. Technology is always evolving. It only experiences a down phase as interest rates increase and the economic outlook is less stable. An option to invest in technology while diversifying your exposure is QQQ, a passive ETF that is tied to Nasdaq, an exchange that is composed of mostly tech and innovation companies. Another is ARKK, a more innovation-based fund, though ARKK has been hit really bad as they invest in growth and innovation. It all depends on your timeline and what you want to believe in. Do you believe in the future of technology? Then this is an opportunity for you to maximize your portfolio with discounted tech companies while diversifying your exposure with ETFs. Moving on, invest your money in consumer staples, the basic necessities of people. It becomes a promising investment during a recession. These are the things that people need to survive: food, certain products, everything that people spend their money on. These are not their wants, a nice handbag, or a nice car. These are the items that people need to live their daily lives. Once you invest in consumer staple companies, you invest in the things people need. This is whether we are in a recession or a good economy. Some popular consumer staple ETFs are XLP and VDC. 4. Invest your money in dividend paying companies. Why is it a good investment? You simply get cash flow. In a downward market, you can buy more shares of a dividend company. When things get back on track, and if you were able to invest in a strong company, not only does the value of your stock increase, but your dividend payouts could also increase. Number 5. Invest your money into emerging markets. This is more of a worst case scenario option where you are not as confident in the US economy and want to diversify your portfolio with companies that are promising but operate in other markets. You are now investing not only in different countries but also currencies, as these companies operate based on the currency of their market. With emerging market ETFs, you will be able to invest in countries like Brazil, China, and even the likes of Korea. You are investing in the companies that grow in these countries. You invest in different currencies since obviously the companies here do not operate on dollars. They do not rely directly on the American economy. It is essentially a way to have a more diverse investment, but it will also have its own set of risks. You invest in countries that are smaller, less military presence, and potentially less stable government structure. There is definitely risk involved, but it is always good to have an emergency kind of protection, and this helps if you are concerned for the future health of the US economy. Lastly, invest in a gold miner. This economic slowdown is unique from those in the past. Why? It is greatly influenced by inflation. If the increasing inflation continues to slow down the economy, people will want to move away from flat currency, the dollar. They will demand a more stable alternative, gold. But if you prefer investing in stocks, you can get exposure to this option by investing in gold miners or gold mining ETFs. One example would be GDX. Right now, you invest in miners that produce gold. Why? Let's say inflation continues over the next 6 or maybe even 12 months. The Fed continuously raises interest rates, trying to resolve the issue. People will then move on from the dollar and prefer hard currency like gold. If the price of gold increases, then gold miners will make bigger profits. However, investing into physical gold is also another way to save hard money. Now, let's talk about strategy. How can you make money during these times? One would be to invest your money for the long term. This does not mean investing it only for 3 months, 6 months, or 12 months. The 2020 crash was a different case. The market fell in March and surprisingly recovered by May. This is due to the inflation caused by the Fed. They printed trillions of dollars and injected it right into the market. There was a V-shaped recovery, which is not going to be the case here. Inflation is already an alarming issue. The Fed is raising interest rates, making new money harder to acquire and more expensive to use. This will slow innovation and reduce demand. There will be more of an up and down motion in the market while on a downward trajectory. This will continue until the economy stabilizes and things get better. How long will that be? We don't know. So, you want to have long-term wealth? You have to invest long-term. These kinds of investors are tested and proven to have generated the most money. Always stay focused on learning and developing discipline, get educated, make a plan, and stay the course. If you found this informative, smash the like button, please share it with a friend, comment down below, and let us know what would you like to have made finance simple next. And definitely subscribe so you don't miss new content. Keep your head up, ears open, and always search for knowledge. See you soon!